arguably the most difficult thing to do in trading once you're in the trade. It's one thing to manage the trade, it's one thing to identify the trade. But how do we target it? In order to address this question, I'm going to ask you, who are you? Targeting in trending markets, as well as how to target in range-bound markets. And for how difficult apparently it is, you'll find out after this module that it's actually quite simple. But it depends who you are and how you consider yourself within the markets. Are you somebody who wants high probability, but is happy to accept low reward? Or are you simply somebody who'd rather have high reward, but can accept a lower probability in exchange for this higher reward? That is the question. So have a think to see which one resonates better with you. It doesn't have to be as black and white as this, by the way. You can take advantage of both worlds, as we'll discuss in a minute. But looking at these two personality traits, there seems like an inevitable trade-off between sacrificing probability for reward. And as you'll see on this graph, it is a bit of a dilemma, but something which we can actually come to terms with and tackle. So here, you can see by this chart that the lower the probability, the higher the reward, and the higher the probability, the lower the reward. So there's an obvious trade-off here, and suffices to say, strategies which have a smaller reward to risk profile, but are higher in frequency, i.e. the intraday trading opportunities, are the ones which are high in probability and lower in reward, whereas the ones which are lower in probability and lower in frequency typically have a higher reward. So again, this really harks back to what kind of strategy suits your personality. Would you rather something which is low in frequency but high in reward, however, low in probability, but you spend less time in front of the screen, versus something which is high in probability, high in frequency, but low in reward, however, you have to spend quite a long time in front of the screen catching the opportunities, as these typically occur on intraday basis. So here's how to target in trending markets, where we have key lower highs and lower lows. You've probably seen price action like this before. And we have our selling opportunity, based on a trendline bounce and some other technical factors in real life. And essentially, we have a choice of two options. Would you rather settle for the high probability option, which has a lower reward, i.e. targeting the previous swing low or just above it? Or would we want a higher reward, but for the luxury of having a higher reward, accept a slightly lower probability and target a new lower low, which conforms to a new technical level, perhaps trendline support if in a downward trend, for example. So there are pros and cons for every one. If you wanted the best of both worlds, however, what you could do is simply take half your profit at target 1, buy back half your position, and scale out, and leave the remaining portion of your trade to go to target 2. That's an idea. To scale out, you can have the best of both worlds, and that's the option I like to do. So you can have high probability and a slightly accelerated reward. You can see it just goes to target 2 in this hypothetical example. But how about a trending market which is going up in a bull market? Well, it's a similar thing, really. We've got key higher highs and higher lows, trendline support and trendline resistance, a channel sign, some of you might refer to it as. We've got target 1, which is the previous swing high, safe in the knowledge that price action has previously tested this price and has respected it. And target 1 will represent our higher probability, lower reward opportunity, whereas target 2, when we go and target a higher high, will represent our higher reward, lower probability opportunity. So there's pros and cons to each one again, but the best of both worlds will be where you simply take price action, target 1, sell half the position and leave half the remaining position to hit target 2. So you've essentially scaled out of the overall move. It's a similar concept within range-bound markets here. We've got a market which is just moving sideways, and we've got key levels of support and resistance, where price action is sandwiched in between. So as it's at the bottom of the range, it makes sense to buy target 1 for a high probability lower reward outcome will be at the midpoint or halfway up the range, whereas target 2 will be in the upper quartile or at the top of the range for that higher reward, lower probability opportunity or outcome. And if you wanted the best of both worlds, then you would scale out at target 1 and leave the remaining portion of your trade to go and hit target 2 whilst trailing your stop loss, safe in the knowledge that the remaining half which has been banked is safe. And in a ranging market also, if we're looking to sell, it's the same concept except we're selling in this example here. So we sell at the top of the range, take it to the bottom, which makes sense. Our high probability low reward trade outcome will be target 1, which is at the midpoint or halfway down to the bottom of the range, whereas target 2 will be in the bottom quartile for our high reward lower probability outcome. This will be at the lower quartile or at the bottom, and again you can scale out at target 1 and leave the remaining half portion of your trade to go for target 2 if you wanted the best of both worlds here. So to summarize, it is safe to say that the higher the reward is, the lower the probability is. Have a think about what kind of outcome you want and what kind of personality you are when you trade. Would you rather have the luxury of high reward and low frequency, however, in exchange for that luxury, have lower probability and accept an overall higher percentage gain with the net sum of all trades? Or are you the kind of person who will be more content with a higher frequency of trades with a lower reward but a higher frequency of wins? Now, targeting your trades is universally regarded as being one of the hardest elements to master of trading, but I can guarantee you, with using this method of doing things, you will find it a lot easier.